Hi, welcome to the Money Smart Show as of May 18th, 2024. Special guest with us today is Troy Thompson. He has a message on life insurance products. So my name is Brian Johnson, and I am President and Portfolio Manager of the Moon Run Report. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. We're bearish. Here's why. We had a shortable correction signal on April 10th. All the requirements match up. And then just recently, last week, we had a minor buy signals that the PEP indicator came in below 3.8. Now, what happens is that, let's go through the list. Rate of decline less than 190. That means the market is falling fast, okay? Normalized new lows at the top greater than 30 and 60 at the sell signal. These are two requirements that separate the winners from the losers, that type of thing. Accelerated new lows calculation is a calculation that I run through to make sure that the market actually is falling precipitously, and all tested true. So the minor buy signal came after this, and what happens is that usually what happens after a minor buy signal, there's a rally, and then it fails. It goes down. This happened in 1987. 2008 in December, there was a little rally and then it went down. And in the 2 years, 2010 and 2018, both of them had rallies that went up and then they failed and went down, and there's big hubbub, all that stuff. So anyways, that's a little bit about the minor buy signal. So here are the market presently. We have a buy, so you can see the market minor buy signal here, and a market strength indicator, which I track, is one of the requirements that I look for in my signals, and it is bullish. And in fact, it's very bullish, but I think it's going to fail here. And just the market is kind of strong, but it's just not the kind of market you want to bet the farm on. You really don't. Right now, I'm out, and it doesn't make a difference. Now, I have a portfolio that is that uses no timing. It's a dandy. It gets 24% a year, and it's doing great. So you might want to pile into that one. It's called Large Cap Portfolio No Timing on my website, Moon Run Report. So let's go on to the next one.
So Brian, one other factor is a low volume, right?
Yes, low volume, not confirming, just not an exciting market at this point. I've heard one firm said that we just hit the top for the year, and we're going to go down. So maybe we will. It's just, you make your bets, but it's not exactly a bet if you have the good indicators. And at this time, the minor buy signal is a good indicator. Here's a confidence index. You can see the market is a little bit stronger than the moving average that we had in the blue line, but here's the New York Stock Exchange Confidence Index that's bullish, and here's the NASDAQ bullish. But, how far it's going to, and fast it's going to go up or down, we don't know. But at this point, the market is not that strong, and we're sitting on the sideline. We might be in, but we aren't. Okay. Now, here's the internal index. It is bullish at this time across the line, but I just don't trust it here. And it's based on advanced decline, up, down volume, new high, new low. It just isn't a big thing that causes commotion. But it does a nice job of calling turns. It does. And this one up here did a nice job of calling this turn here and this one. And this is NASDAQ. This is New York Stock Exchange. And so minor buy signal, flopping back and forth. That's what we have. So let's review the Moon Run Report and how you can use it. Okay, I have several portfolios, $10 per month, first month free, and I have 8 different portfolios. 4 of them are timing, 1 of them is not. We have a FANG portfolio, index funds, and also ETFs. So We have a smattering of things, and the intent is to invest in proven portfolios to generate high returns. Sell out before bear market hits and buy at the bear market over. Here's my track record. World champion 2008, run up 2009, and bond timer of the year in 2019. Fidelity account up over 20%. Compounded average growth rate since September 2008. That's what it's done over the years. Nice success rate, but it's nice to have. You have to make sure you do just as well going up. Hobart Financial Digest, #1 for the past 12 months out of 14 different newsletters. And I think that's really great. So maybe I can do it again. Called bear markets in 2008, 2011, 2018. And my research began 2005 when I discovered this tsunami indicator. And that's how you keep, not only do you discover it, you keep on going. You make sure it works. What the Moon Run report contains. Okay, we have small cap, minor cap, mid cap, large cap, FANG, index funds, ETFs, and there is a portfolio called the no timing. So that's what's going on now. Is a dandy, a really good portfolio. You don't have to time it. And you know something, if I had discovered this way back when, I would have ditched all my timing efforts and gone with it, but I didn't. So, you know, it's a great portfolio, and 24%, that's better than Warren Buffett is and doing, and much better than some of the other successful money market managers out there. 450 stock portfolios and portfolio 1, 2, 3 designer model, no charge. Okay, there's in portfolio 1, 2, 3, they have these designer model. So you can go there and invest in them. Charts describing indicators for market direction, bear market signals, when to get out, when to get back in. Weekend updates on Friday nights, stock replacement on Monday mornings if we have to, and first month free, $10 a month thereafter. Okay, examining the portfolios. Here's how well they've done over time. Small caps, a back test from 1999 to 2024. We have, that's a 49.97% compounded average growth rate, almost 50%, really spectacular returns you can get out of it. And, you know, Warren Buffett claims that he can do, if he had a $1 million account, he would look into small caps and he would get 50%. Well, I've done it. So, you know, that's what I use it when I invest. That's what I do. Maximum drawdown 36% a year. Turnover rate 354, a little bit high, but that's not as high as some small cap portfolios can be. 50,000 shares a day. That's not too bad. And we're looking in 15 to 250 million market cap. Okay, here's the performance since 1999. 2,800,000%. That's not too bad, don't you think? Minor cap portfolio. This is between the small cap and mid cap, between what is it, 500 million to 2 billion. So a different kind of setup. I was able to get 28% out of it, but in this presentation it says 24, and we have a maximum drawdown of 25.9%. Turnover rate over 100%, which double your. If you have a 10 stock portfolio, maybe you'll sell 12 of them and buy and sell 12 of them in a year. Minimum average daily volume, 75,000. Here's your performance, 24,000%. That's not too bad. Mid cap portfolio, back tested from 1999 to 2024, 25% a year compounded average. Maximum drawdown, 18%. That's really low. Turnover rate of 100%. Minimum average daily volume, 100,000. Search university market cap between 2 and 10 billion. That's about the right range. And then we go, here's the 32,000% from inception. Large cap portfolio, back tested from 1999 to 2024, 23%. Maximum drawdown, 26. And turnover rate, 138. Minimum average daily volume, 100,000. And we look in the Russell 1000, which is the large cap portfolio for our stocks. And we have this 32,000% from 1999. Altogether now, we combine the averages, 31%, average compounded growth rate. So maximum drawdown is 20.43%, which is actually pretty darn good. And for all of them, if you did it, 110,000%. So here's a little chart about how $100,000 becomes after 10 years. Combined, it goes to 1.6 million, 31%. And then for 15 years, it's 100,000 invested becomes 15 years. It's large cap is 2.6 million, mid cap 3 million, minor cap 3 million, small cap 38 million, and combined is 6 million, so 6.4. Nice return. No one calls bear markets like Brian. Okay, this is a section on YouTube. You can go in and you go to YouTube and then you type in Money Smart Show and box, and it will show you a lot of things that you there. So 1987 to the present, a lot of bear market analysis. What happens before the bear market, when to get back in, that type of thing. Various helpful tips, especially on the option timer too.
Brian, I just want to mention that I added a couple videos in the chat, so please subscribe to our Money Smart Show there. A lot of amazing videos on bull market, bear market, all the triggers.
Yeah.
Thank you.
Thanks, stocks. Okay, here we have what is it? Netflix. This is one of our stocks that we have in a FANG portfolio. It is bullish, you can see, and we're still riding it up. Did a nice job. It came through a difficult period here, and but it came through, and we got a buy signal. What we do is you say a weekly timer on this is called DCAM. It's the opposite of MACD. It works a little bit better than MACD. They're using the 9-period moving average with the MACD, but has less trades. That's what's nice about it. So I like it. It's consisted of one moving average, a double moving average, and stochastic to remove whipsaws. And by golly, it does a good job.
Brian, what trigger did you use? All the red signal there. And
that is the from DCAM, the timer that I just told you about.
Okay.
It draws these charts, as you can see.
Okay, thank you.
Here's Microsoft. Okay, a buy signal here, and up and up and up. There you go. And then we have the what is this? Meta, Facebook, up, and then we had a sell signal, big collapse, and we came out. Still waiting for it to give a buy signal, but it hasn't so far, and it's doing that. Okay, here we have Alphabet, Google, and as you can see, up and up and up and up. There you go. Hit a new high just this time, and we're waiting for it to go through its period. So, and then we have Amazon, which is still bullish, and we go through here. It's near its top, and maybe it has some better days ahead. So we'll see. And here is Apple. Apple is on a sell signal now. We came out. It's been rallying. Well, we'll see what happens here. We don't go in until we get a blue buy arrow, and that's what we're waiting for. Okay, stop sharing, and we're going to have Troy Thompson come in with his ideas and his presentation. Troy?
Yeah. Well, thanks, Brian. Great to be here. And whenever you get a chance to load up, Matt, you can start the screen.
Let me do that now.
As Brian was going through all that information, I was thinking to myself, what a value for $10 a month, and I get access to all that information and his guidance, his outlook, and the different portfolios. And just what a tremendous value for a person who has a desire to do some on their own, or maybe all of it on their own, as far as managing my own portfolio, as opposed to handing my money over to someone else and hoping that they do a good job. I can just follow Brian's advice. So appreciate being here. My name is Troy, and I am the owner and founder of Angel of Freedom Financial. You can go to the next slide. And I'm a financial strategist, and I work with a team of experts to help people achieve their financial goals, their freedom goals, really, whether that's time freedom, money freedom. My particular area of expertise is life insurance. I have a life insurance license. I'm really only going to talk about that just a little today. I talked with Brian earlier in the week about what kind of content had happened previous. And he said a previous person talked a little bit about life insurance, or maybe actually the whole time. So I'm only going to discuss it a little at the end. I think I have other information that's valuable to a much broader audience related to stocks and trading. And my disclaimer is, talk with tax professionals, talk with an attorney, talk with people who have a securities license, and my license is life insurance. And so speak with those experts to make sure that validate what I'm saying. Next slide, Matt. So what is the greatest expense in a lifetime? So since I know I got Brian and Matt on here, what do you guys think the answer is? Throw something out. What do you think? Greatest lifetime expense?
I can't say.
Go to the next one. Next slide. It's taxes.
Yeah.
Right. Most people would think, oh, it's my mortgage, right? Buying a house. Over the course of a lifetime, though, the biggest expense is probably taxes. And so even subtle differences in reducing my tax can have a tremendous difference over my long-term wealth accumulation and wealth distribution. When I say I'm accumulating money in an account, and then now I'm using that account to live on at some point down the road, just small my tax.
Troy, your something's happened.
Connection.
In the overall outcome. And so, okay. Yeah, sorry, a little. Can you hear me still?
Yeah.
Yes. Can you hear me still?
You're back.
Okay, sorry about that. Yep. Living in a new area and the so, traditional IRAs, they're taxed as earned income. So it doesn't matter. So let's focus in on stocks here. And let's say I bought Tesla or Google, whatever, it doesn't matter. And I've held that thing for 10 years and I have a great gain and I sell it for whatever reason. Well, if it's in, say, a cash account, I would normally have a capital gains, and it would be taxed at capital gains tax rates, which vary depending on my income. But keeping it simple, capital gains tax rates are usually better than income tax rates. Well, anything that's inside an IRA, doesn't matter what it is, when that money comes out of that traditional IRA, it's taxed as earned income. So this is something to be aware of. I still may put equities. In fact, I probably will put equities inside my IRA, but I need to have an awareness that no matter what it is, what the asset class is, no matter how long I've had it, when I pull that money out, it's going to be taxed as earned income. So bonds, right? When I have bonds as part of my overall portfolio, bonds are a good place, or excuse me, an IRA is a good place for me to have bonds. Why is that? Bond interest is taxed as income. Basically, it's income. So if I have just a cash account and I buy bonds, that interest is going to be taxed as income. So I may as well put that inside my IRA because, like I said, every IRA distribution or every IRA withdrawal is going to be taxed as earned income. And equities might be better served in a cash account, a brokerage account, whether that's I'm simply doing a capital gains approach, buy low, sell high, or if I'm doing a dividend strategy, that's going to be taxed more favorably in a cash account. Okay, so now let me be clear here. I'm not saying don't put equities in your IRA. I'm saying when I have equities and bonds, the IRA is the place for my bonds. It's fine to have equities in my IRA as well. Just I might be losing a little bit of tax advantage that I could gain if it was outside of that IRA. Next slide. So this question comes up a lot. Well, should I contribute to a Roth IRA or should I just do the traditional IRA? This is a big crystal ball question. There's so many variables. involved as far as, okay, what's my income today? What do I expect my income to be later? What are tax rates today? What do I expect tax rates to be in the future? So there's lots of unknowns. Keeping it simple, if my income is the same today as in the future and the tax rates are the same today as in the future, it doesn't matter. It's basically a wash. The results will be the same if I have it in a traditional IRA where I'm deferring the tax for later, or I have in a Roth IRA where I make my money, I pay the tax, and then I put it into the IRA. So how do I decide whether to put it into a Roth or not, do a traditional IRA or not? Part of that is, what do I expect my retirement expenses to be? Again, another crystal ball question. But as I'm approaching that time period, and I put retirement in parentheses because that varies so wildly. I have a client who's 70 years old and he's still working part-time because he likes it and he wants to do it. So I'm looking at, okay, what do I expect my expenses to be? As the higher my income gets, the more sense, in my opinion, the more sense it makes to put it into a traditional IRA. And of course, at an income level, approximately 200,000 for a married filing jointly, the IRS doesn't allow me to directly contribute to a Roth IRA. I have to contribute to a traditional IRA and then convert it and play these games that the government and the IRS makes me play. But kind of put some numbers to this. Let's say I'm making up my higher income earner. I'm making 250,000 a year, but I'm spending 150. That's my lifestyle. Well, when I retire and my working income stops, let's say even if my expenses, like, I do more travel, I spend more money for whatever reason, even when I raise my expenses up to say 180,000, well, then I'm going to pull income to cover $180,000 worth of expenses. So $180,000 is less than $250,000. So my effective tax rate is going to be lower. So this is the value in talking with a tax professional or financial advisor who has an expertise and can talk through these scenarios about what's my current income and expenses, what do I think future income and expenses will be. Let's go to the next slide. So pre-retirement planning versus at retirement planning and during retirement planning. The goal is achieving the highest net spendable amount. Right? Now, maybe I don't spend it, or maybe I use the expression the 3 C's, which are church, charity, and children. So maybe I want to leave it to church, charity, or children, or maybe I do want to spend it. The goal is that after taxes, after fees, I have the highest net amount of money spendable possible. So here's the thing about that I've noticed with clients who have their money in traditional IRAs is, let's say it's $500,000. It doesn't matter if it's 100, it's $1 million, it's 5 million. That account balance, when I look at my balance and I see, oh, I got $500,000 there, I think I have $500,000. But that's deceiving to me because that money is yet to be taxed. Right. So depending on how much I pull out, other income I have, that 500,000 is really like 400,000 or maybe even less. Conventional advice is, let's say I'm retired, right? Let's say I'm 65 and I'm retired and I have other income sources and I don't really need the money from my traditional IRA. And I keep saying traditional IRA, but it's basically any account that is yet to be taxed. So it could be a 401k, it could be a 403b, it could be a simplified employee pension, any of those accounts where I've deferred the tax. The conventional advice, if I don't need the money, is to continue to defer. Just wait until I need to take it out and then take the minimum distributions. Deferring generally means paying more in taxes. So I highly encourage people, certainly when they're around 59 years old, it makes sense to look at it younger, but certainly when a person's 59, 60 years old, it's time to take a look at those accounts and discuss doing some strategic rollout or rollover. So roll over moving it from an IRA to a Roth IRA, roll out, just simply taking it out of the IRA and then putting it in some other investment. And so part of what I do is I help people with this puzzle, figuring out the right strategy, the right timing, how many years to do this over, because maybe it's done over 3 to 5 years typically. 5 years typically, maybe it's a little less, maybe it's a little more. But regardless of whether it goes to a Roth IRA or it comes out, the money is going to be taxed, right? When it moves from that traditional IRA, there's going to be a tax implication. What I do is help people do something over here to offset that tax. So minimize the tax implications of that rollover. And then something to be aware of, and this is another reason why I encourage people when they're around 60, certainly 65, to start looking at this and doing this, is when I move the money into the Roth IRA, there's a 5-year period in order to get the maximum tax benefits of a Roth IRA before I can move the money. Next slide. And see, I have a couple minutes. So this is just a snapshot of the current tax brackets. And I don't know if you're able to put your cursor, say, on the married filing jointly, 24% there, Matt, a little lower. And people have a misunderstanding of the way the tax brackets work. So when I make, so say that column that he's on their married filing jointly, and let's say I make in that $94,000 to $200,000 range, that's the 22% tax bracket. But so if I make $100,000 and let's say I had no deductions, that does not mean I will pay 22% in tax. So it does not mean I'll pay $22,000 in tax. It's a graduated scale. So from 0 to 23,000, I'll pay 10%. From 23,000 to 94,000, I'll pay 12% on that money. So this is good to know when I'm doing some strategic IRA tax planning, that yes, it might make sense to move $300,000 all in 1 year. And then people freak out. It's like, no, that's going to put me in a 32% tax bracket. Well, only the dollars that are in that 384,000 and up are actually going to be taxed at 32%. So this is the value, again, of speaking with someone who understands the tax brackets and looking at what are the scenarios and doing some tax planning. Next slide. And I think I'm close to finishing up here. Oh, I'll just briefly mention sequence of returns. All right, sequence of returns is referring to the implications of the return as I'm at the end of my working years and beginning of my retirement years. And what I noticed with a lot of do-it-yourself stock traders is they always think they're going to continue to be actively involved and get 20% or more. And it just makes sense to take a portion of a person's portfolio and put it in something that's more conservative and have that protected and preserved as a sleep at night type of plan. And life insurance, that's the last slide. Life insurance, cash value life insurance can be, you can go to the next slide, Matt, can be a piece of that puzzle. An annuity can be a piece of that puzzle. I think, so there are well-known people out in the financial world. They have a big audience. They're really more entertainers. And they would say, if a financial advisor ever brings up cash value life insurance, that's a reason never to work with them. In my opinion, it's the responsibility of the financial advisor to discuss the advantages and limitations of cash value life insurance, discuss the advantages and limitations of an annuity, discuss the advantages and limitations of bonds, share all that information and see how they all work together to be complementary and synergistic. Last slide, I think, is contact information for me, if I remember correctly. Yeah, so these are different ways to connect with me. Mention that you saw me on the Money Smart show with Brian, and that can get you a discount if for future work. Initial meeting is complimentary. So initial complimentary review to see if there's any way I can help. And you can stop the screen share. And that's what I have for today. I appreciate the time, Brian.
Okay, thank you, Troy. A great presentation always. We have 15 minutes of expertise here, and we'll be here back again next week with another guest. Matt, at this time,
Yeah, I just want to mention about our new AI assistant that I just put together. It's ongoing projects. We're going to be adding AI assistant for some of these triggers for bull market, bear market, and short corrections. Please go check in. Just go into the booth, and we will have an AI assistant there. Once again, this is for education only. So this is where, if you have any specific question, please ask the AI assistant. And then if you have any question that the AI cannot answer, well, you can put the question over here in the chat, or you can come back to the podcast or Money Smart Show next Saturday to ask Brian directly. So anyway, this is an ongoing project. Please invite everyone to join us here. Once again, thank you everyone for joining this Money Smart Show. And that's it. Thank you.
Okay, Matt, thanks for the post commentary, and we'll see you next week.
Thank you.
Thanks,
Thank you, John.
John. Yeah, my pleasure.